how is lending currently, or kind of give us the history of lending in digital assets. Where did it start? Kind of take us to where we're at today.
So yeah, well, in terms of lending for digital assets, I would say so we have been in the space since 2018, 2019. With idle finance, especially, we started like building yield aggregators. So we have been touching a lot of the early lending protocols in DeFi. And what we have seen since the beginning is that like lending application, credit application in DeFi started out as purely over collateralized lending, which makes totally sense in a completely anonymous environment and allowed to create the first instance of interest rate markets, of money markets in DeFi. So that was kind of like this part of what is going to be the broader credit market on for digital assets. What we're seeing right now in terms of kind of trends, I would say is that we see a meaningful shift in the institutional approach to digital asset markets. While the early DeFi wave, and I'm talking about, for example, 2020, 2021, was pretty much focused on, things like yield farming, liquidity mining, pretty much, speculative activity, which brought a lot of growth. The narrative I see right now is shifting towards capital efficiency, sustainability, for example, and also automation, thanks to this kind of on-chain infrastructure. And what I see also is that at the same time, if you look at macroeconomic conditions, these conditions have created a strong demand for stable yield and operational leverage. Capital allocators want real underwriting frameworks. Borrowers want flexible, reliable sources of liquidity. So what I saw and the evolution that I saw over the last 6, 7 years in DeFi is that tokenizations and credit are now seen as core building blocks of the digital financial infrastructure. You can see that from like recent reports. Right, one that comes to my mind right off the bat is like a McKinsey report that suggests that tokenizing assets and credit flows can unlock trillions in efficiency gains actually for the digital markets. But to get there, we need programmable, trusted systems that bring the advantage of DeFi, like transparency, automation, real-time settlement, to the traditional lending markets. So yeah, from an environment that was purely like tech savvy and really focused on over collateralization, the money markets and the credit markets in general, I see that is shifting towards a more traditional approach by still bringing all the advantages of on-chain infrastructure.